Thanks for joining us this week for our weekly investment update that we call Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer at Signature FD. And we'll start here with our chart of the week. We title this one Stating the Obvious, and that's because some high profile CEOs from Goldman Sachs and Morgan Stanley had come out and said that they were expecting a 10 to 20% pullback within the next 12 months in the market. And so naturally, we got some client questions and concerns about that. And when we think about corrections and the probability of corrections, our response is a little bit flippant in that, well, yeah, we would expect a 10% correction over the next year too, simply because that has tended to be the case. The average year has experienced a 10% correction. So what we're showing here in this chart is the amount of occurrences in each year for a 3% dip, which you can see is about 7 times per year, a mild correction of 5%, which happens almost 3.5 times per year, that moderate correction of 10%, which happens over 1 time per year. And then even a bear market happens about once every 3 years. So expecting elevated volatility in the next 12 months is not really going out on a limb, seeing as that is actually what tends to happen in an average year. It's not fun to see your stock investments drop 10 to 20%, but it is part of the process. That volatility is the reason why investors earn a premium to risk-free rates for being a stock investor. So just want to point that out. And we feel like if we can normalize and make clients aware of how often these occur, that we can be better positioned to ride those out and to absorb them when they do happen. All right, so looking at some of the market action last week, one of the reasons why I think that correction evidence was kind of spooked people so much is because the markets had a bit of a down week last week, about a 2% loss. But when you zoom out to the year-to-date gains, you can see that any corrective action last week was really within the scope of an ongoing bull market in most assets. So the S&P 500 is still up 15.6% this year. Small cap stocks still up 10.3% this year. Commodities still up 12.6%. Developed international markets up 26%, and emerging markets up 32%. Now, one of the things that is notable is that the dollar has really stopped depreciating. It's been around this negative 8% year-to-date level for a while now. That's not necessarily a bad thing. Stability in a variable like the dollar is important for asset markets, but it has removed a little bit of that tailwind that international stocks got earlier this year. But nonetheless, yes, a little bit of corrective action, but within an ongoing uptrend. So looking at some of the macro data that were really driving the trends last week, one of the things that caught our eye was the layoff announcements. So we get this data here, the Challenger layoff announcements. And you can see that layoff announcements spiked to 153,000, which doesn't look like it's an outlier when you look at the blue line on this chart here, but it is an outlier for the last 3 months of the year. Companies don't really do a lot of firing in the last quarter of the year. That tends to be more of an early year thing. So to have a high reading in October did catch our attention a little bit. Now, a lot of these companies did blame it on AI and productivity enhancements because of AI, so they just don't really need as many employees. But that being said, it did catch our attention. And we think this rise in layoff announcements is directly contributing to some weak consumer sentiment. So we also got the latest reading from the University of Michigan Consumer Sentiment Index. You can see that in orange here. And that fell down to 50.3, which is the lowest reading in some time, really outside of the pandemic era confidence readings, you can see that the year-to-year change in confidence in that bottom clip in light blue is down about 30%. And that has fairly recently flashed a negative signal for the economy. Now, that doesn't necessarily mean you're going into a recession. In fact, the negative signals have still coincided with very mild positive economic growth of 0.1% annualized. So, not necessarily calling a recession, but it does emphasize that the economy has been softening here in the last couple months. Now, that said, you have to kind of weigh that against some other indicators that we see. And the ISM Services Purchasing Manager Index last week did move higher fairly meaningfully, up to 52.4. And 50 is the zone that delineates expansion from contraction. So we're a couple points above expansion in the service sector. And it was good to see a bit of a rebound there in services because services make up the lion's share of this economy. So for today, services don't really line up with breakout economic growth, but they do line up with positive earnings growth or economic growth anyways, and that's been an encouraging sign to see. So very much mixed messages from an economic perspective. We're still going to want to watch the job market. We're still going to want to watch consumer confidence. There's some important offsets coming up next year in the form of tax refunds and general stimulus heading into the midterm cycle. So that'll be something to watch. Now, we always want to pay attention to fundamentals, especially as we're like starting to wrap up the earnings season from Q3. It's been a pretty positive earnings season. Here we're showing a chart that narrows in on the median company in the United States, and that's among small caps, mid caps, and large cap companies. And you can see here the top clip is showing profit margin for that median company, and it's been expanding. So profit margins were at 12.8% last quarter, looks like about 13.5% this quarter. So we're getting some healthy margin expansion here, and that's funneling through to improved earnings growth. So it looks like earnings grew about 8% in Q3 for the median company on a year-over-year basis. Pretty solid earnings growth. And that's coming off of, again, solid sales growth of 6.5%. So there are some hiccups from an economic perspective, but the fundamentals are holding up. Decent earnings growth on good sales growth and increasing margins is a good story for the market. Now, you need that fundamental improvement because valuations are a little bit stretched here. Now, I want to say that valuations are far from being in a bubble from our perspective. And that's been kind of the concern that clients and investors have generally had. You can see here, this is also looking at the median stock across small, mid, and large cap companies in the US. In that orange clip in the bottom, that's showing the median price to earnings ratio. Now, this is a trailing price to earnings ratio. So these are the 12 months of earnings that have actually happened. But you can see that the market is at about 26 times trailing 12-month earnings on median. And that's stretched. It's about 2% overvalued, but it's far from being majorly overvalued and much of a problem today. So as long as the fundamentals are coming through, we don't see valuation as too much of a concern, at least for the median stock in the index. Now, the same can't really be said for all stocks in the index. So here we're showing the dispersion between the expensive stocks and the cheap stocks. And on average, the spread between those is about 11.7. So you can think of if the low stock has a PE of 10, then the high stock might have a PE of 21.7. That's the way to think of that. Well, today it's at 16.1, the spread between the cheapest and most expensive. That's a pretty wide spread historically. And what's driving the expensive stocks are really the AI and tech and the AI tech adjacent themes out there is what's driving it. Much of the rest of the market is much more cheaply valued. And we want to give a PSA on that note, and we don't think it's time to necessarily bail on the AI theme or anything like that. But we do want to remind investors that these themes change all the time. New themes grab investor attention on average of about every 10 years. New themes come in and really change the scope of what's the largest companies in the index. So I think this chart does a really nice job of showing that in 1985, you had 10 names, you had some energy in there, some industrial type things in there. Then by 1995, you ended up with 5 new companies in that top 10, and only 5 of the previous companies were in there. By 2005, only 3 of those companies remained from 1985, only 1 company from 1995, and you ended up with 6 new names in 2005. Same sort of story in 2015, where you ended up with 5 all new names, only 2 of the original from 1985, and only 2 from 2005, and only 1 name from 1995. So here today, when you look at the composition, you can see that 2 of them remain from 2015, 1 of them remains from 2005. Sorry, 3 of them remain from 2015, 1 from 2005. And so you have now a new 6 companies that weren't represented in any of these prior decades. So we don't know exactly. It's tough to tell what's going to be leadership over the next 10 years. It's really hard to forecast that far in advance. But we do have confidence in saying that investors' attention spans are probably going to shift elsewhere, especially since valuations are pretty rich for this tech and AI theme. Now, that said, again, we don't think it's time to move off of it yet. And we want to give the bull market just generally the benefit of the doubt. So what we're showing here in orange in the bottom clip, this is a measurement that is done by Ned Davis Research. It's one of their most famous indicators. And it just shows the percentage of industries and sub-industries that are in uptrends. So if you're basically, if you're an energy sub-industry and you're in an uptrend, you get counted as positive in this. If you're a materials sub-industry and you're in a downtrend, you get counted as negative. And you can see that it's about 62% of industries and sub-industries are in uptrends right now. That's a pretty healthy reading. You need to get down to something around 45% or so to generate kind of a negative signal on the market. But for now, we want to go ahead and give the bull market the benefit of the doubt, because there's a good amount of industries and sub-industries that remain in uptrends. All right, so our closing thoughts for this week, the chart of the week here really just focuses on corrections and how often you can expect these to happen. They're unfortunate. Nobody likes to see their portfolio going down from its high water mark, but they do happen. And because of that, I want you to be cognizant of it and beware of market commentators that are warning of corrections ahead when corrections are inevitable. They tend to happen at least once a year. You tend to get a 10% correction. So that doesn't really give you that much information. Now, there was some corrective action last week, but the bigger picture here is that the uptrends do remain intact. Layoff announcements were unusually high for October, and that certainly caught our attention. And the softening labor market has been denting consumer confidence, and that's something that's also important to pay attention to. But there's some offset in some other areas and other indicators that we look at, and one of those is the service sector, which has improved despite those headwinds to the consumer. And we think that the tax refunds and the lower Fed funds rate in 2026, that stimulus could shore up the economic backdrop next year. Now, fundamentals are very solid for the median company. The AI theme has gotten expensive, but the median stock is not glaringly overvalued, and we'd say it's far from being in a bubble. Now, most industries are trending higher, and that's a healthy condition for the sustainability of the bull, but further deterioration, much like the jobs market and the consumer confidence numbers, further deterioration in those technicals, that would get our attention as well. But for now, we do want to give the bull market the benefit of the doubt. So that's what we have for you this week. And as always, I want to thank you for joining us and wish you a great week ahead.